Well, last week we broke through the 4.42% floor and it looked like a real breakout. This week, MBS lost 55 bips, the 10-year rose 11 and a half ticks, and by Thursday's jobs report, we'd had a wild ride that pretty much ended with us back up to where we were prior to last week's rally. Let me walk you through what happened, and then there's a Fed story that can make for some compelling news with what comes in the future. So for the week, MBS finished 55 bips down, essentially wiping out the 54 bip gain we had the week prior. Pretty much a mirror image. The 10-year Treasury rose 11 and a half ticks. In Thursday's June jobs report, the NFP came in at about half of the expectations, 55K jobs instead of 110K jobs, and then the prior month was revised downwards by 25%. Employment technically fell, but that was also due to a labor participation rate decline. So how did we get here? This week told a story in three parts, and none of them were about geopolitics for once, it seems, which was a change of pace. Part one, quarter-end selling. Monday was quiet, down 4 bips, nothing to see here. But Tuesday, quarter-end trading hit hard. Mortgage-backed securities dropped 52 basis points in a single day with no escalation headlines. No oil spike either, just technical selling pressure when institutional money repositions itself for the end of the quarter. This is one of the things that nobody warned you about, but we do have to monitor it on a quarter-ending basis. Part two, and this is a little bit of a more interesting story, the Warsh Effect. Fed Chair Warsh had his first presser that was not FOMC related. And here's a fascinating thing that we saw. Same pattern that we saw at first. He started talking and mortgage-backed securities gained. They rallied. And then about halfway through the day, the market said, I don't know about this lack of forward guidance. I don't know what that really means. The market doesn't really like uncertainty. And so with providing a little less transparency, the markets pulled back a little bit. So we're going to monitor that over the next 6 months to see how the market reacts to Warsh. Part three, Thursday's jobs report. Again, came in half of the expectations. We opened down prior to the report 20 bips, popped up 25 bips once the report came out, so a range of 45 basis points. Things look good. The report itself was actually very bond friendly because of the weaker jobs and the revisions downwards of the prior reports, but it faded again on Thursday. And it was a short trading day. You get a little bit more volatility, especially with a day off on Friday for the holiday as well. So the story of the week was technical selling took our gains. We didn't see, again, anything come from geopolitics. We just couldn't overcome the Fed uncertainty. So what we want to watch out for this week is for geopolitics. Something came out over the weekend where Israel bombed Beirut. And so the administration said, we really didn't want you to do that because we're making progress here with the peace talks. So what we're doing now is we're going to continue to monitor the market's reaction to the FOMC. This week also brings ISM services, which is a top 5 economic report. So that was the week. Rough one, but that's how markets work, right? We don't get to pick and choose. So if you want to know what this movement means or you want to keep up to date with what's coming up, please feel free to reach out. You can go to www.johncobainhomeloans.com. The link's in the description.